Welcome to Upticks. I'm Jake Falcon.
And I'm Corey Bittner. We're the founders of Falcon Wealth Advisors and your co-hosts for Upticks.
Today is our 28th episode, all about your income.
We're going to talk about Social Security. We're going to introduce a new segment called Questions Worth Asking. And we're also going to talk about how to generate more income from your portfolio.
Okay, to introduce our financial planning segment today, Corey, we wanted to discuss changes to Social Security for 2019. So why don't you go over with our viewers some of the changes that are coming up here in January?
Sure. In talking about the big changes, really worth noting, first and foremost, is that for beneficiaries of Social Security in 2019, they're going to receive a raise. In fact, the percentage that they're going to receive is bumping up to 2.8%. It was 2% last year.
So they're getting a 2.8% raise?
Correct.
Nice, okay.
In fact, this is the largest raise that's come from Social Security since 2012.
Okay. In our financial plans, for most of our clients, we typically factor in a 2.5% raise. So this is above that average that we look at. So that's good.
It is good. And interestingly enough, for 2019, it's 67 million beneficiaries are the number of people that are going to receive this increased amount from Social Security. So that's probably one of the biggest items to know. People are getting a little bit of a raise. Again, I know it's not a huge dollar amount, but it is something. Right?
It all adds up. Yeah, it's definitely an increase. What else you got?
Yeah, so there's also really kind of the other items to note are, so if you're not retired and you're still working, the cap dollar amount that you pay into Social Security on is going up also. So let me kind of explain what that means. For tax year 2018, if you earned $128,400.
What a weird number.
I don't know where the number comes from.
Okay.
Your guess is as good as mine.
All right.
As far as that number goes, you would pay into Social Security up until you earn that amount. And if you earned more than that, you would actually see your paychecks get bigger because your Social Security is maxed. I know I've had some conversations with clients that say, this is my favorite time of year because my paychecks get bigger because I've maxed out Social Security.
Yep, absolutely.
Next year, that number is going up from $128,400 to $132,900.
Oh, wow.
Another random number, but it is going up.
That's a pretty big increase, though.
It is.
Which is a good, a lot of clients will come to us and say they're concerned about Social Security running low.
Right.
This is one way that the government or the administration can make changes to keep more money going into Social Security. So basically they're increasing the cap to which people are taxed on their paychecks.
Yeah, and in 2017, that number was about 118,000. So it jumped from 118 to 128 to almost 133 now.
Wow, okay. Good. Do you have anything else?
No, outside of that, there was one other individual point that I wanted to make in terms of, we've talked about the raise, we've talked about the maximum taxable earnings. The one other piece that I wanted to speak about that I know is pertinent for us is doing retirement planning is the earnings limit. If you are collecting benefits prior to your full retirement age. And then there's actually one other point I want to make that I'm going to talk about first. Full retirement age is continuing to increase.
Right.
For those who turned 62 in 2018, the full retirement age in terms of the Social Security's eyes is 66 in 4 months, but for people who turned 62 in 2019, the full retirement age is increasing to 66 in 6 months. Full retirement age is set to increase by 2 months each year until it hits 67. So that's another, going back to the point you made earlier about people who have had concerns about Social Security, they are continuing to increase what the full retirement age is. So with that being said...
Well, let me talk real quick about that, how that would impact somebody. So the idea is if you're still working or you're born on a certain day, your full retirement age is predicated on the year that you were born. And that's what Corey was getting at, is that so that changes. And the idea is that a lot of people want to wait until their full retirement age before they start receiving benefits. But in many cases, as is the instance for a lot of our clients, is they'll actually start collecting early. And the earliest you can collect is at age 62.
Right.
And so what, Corey, I think you were alluding to is that if you're 62 and you're collecting Social Security and you are working also, there's a cap on how much money you can make before they start to penalize your benefits.
That's exactly right.
So what has changed regarding that?
And that's what I wanted to talk about here. So and let me actually pull up the 2018 number. So for this year, it is $17,040 a year.
Okay.
For 2019, it's going up to $17,640 a year. Again, not
another
a huge
weird number.
difference,
I don't know where they pick these
number.
random numbers.
It basically goes up. They look at an average monthly amount. So they figure that $17,040 is $1,420 a month, and it's going up to $1,470 a month. So basically, it's going up by $50 a month from their standpoint, and I think that's how they get to that annualized number. So the fact of the matter is, you can. If you're collecting Social Security before your full retirement age and you want to earn some income, the dollar amount that you can earn is going up a little bit.
Okay. I looked up some fun facts about Social Security also.
What you got?
Well, there's a book out there called Getting What's Yours, I believe is the name of it. Mm-hmm. It's probably the premier book written on Social Security. Corey and I both have a copy of the book, and it's something that we use as a reference guide for our clients. So I was thumbing through it last night in preparation of our show today. And there's some pretty interesting fun facts I've got here on my phone is basically you have to notify Social Security of what's going on in your life. Nothing happens automatically. So that means if you want to turn on benefits, you've got to notify them. If you get divorced and you want to see how that impacts your benefits, you certainly have to notify them as well. So again, they don't do anything automatically, which is interesting. I think a lot of people think that if they turn 62 or...
that it's just going to start.
Yeah, and it doesn't work that way. So you've got to be proactive when you're looking at your Social Security benefits. And that's actually... Go ahead.
Well, I was going to say, that's just something that I get asked about pretty often. If I were planning to start collecting... Let's say I turn 62 next June, and I wanted to start collecting benefits the month after that, when should I start the process of applying for benefits?
Yeah, normally we suggest at least 3 months prior to you turning age 62, just to make sure that everything's filed correctly and things get turned on how you want them to get turned on. And then we certainly like to meet with all of our clients around that time frame also to make sure that we have your financial plan projections correct. And if we need to tweak anything or make any adjustments, we're happy to do that as well. Now, one other item I wrote down is that filing early, like I've already mentioned, can be a winning strategy. So it doesn't mean that you necessarily have to wait until your full retirement age before you do turn on Social Security. Also, Social Security may be taxable. I think a lot of people don't understand that. They think that since they've already paid into it all of these years, they don't recognize that even if they're collecting it in retirement, depending on their income bracket, it may be taxed. And then, also I think it's frustrating. Well, it's maybe part of the reason that we have a job. It's frustrating, though, that Social Security reserves the right to change the rules,
right?
Which they obviously do a little bit every year. They tweak things. And so it's important that you stay up to date on it. And certainly our clients hire us to do those things for them. Like I said, it's something that's a little bit more complex. I know when you call in, sometimes the hold times can be frustrating and you might hear different answers. So again,
I've had that experience.
Yeah, so there's a guide of reference out there that we use. Corey and I basically stay up to date on what the laws are as they change, and we plan accordingly.
So let me ask you a question then. This is maybe more of kind of like a high-level philosophical question, but I know a lot of the times with the advices we give to clients, why do you think that it is so common that if you just Google the best time to collect Social Security, or you talk to different people and get different advice, so often it seems like some of the advice that's given to people is to just delay taking it as long as possible? And we're talking about how for a lot of the times collecting it early can be a winning strategy. Why do you think that's such a common... Why do you think it's so common for people to say, wait as long as you can?
I think, sadly, most Americans haven't saved appropriately for retirement. And so I think they don't have a nest egg, or their nest egg is small relative to the amount of income that they're going to need.
Sure.
So, if that's the case, then you probably should wait until you're 70 years old and max it out before you receive it.
That's a good point. Because I think, and actually what I'm looking up right now is I wanted to see what the average retirement account balance is, to your point,
yeah,
what it is that we're talking about. The average 401k savings rate in 2017 was 6.8% according to Vanguard, and the average 401k account balance is just over $100,000.
Right, and if you're planning out a 30-year retirement phase, $100,000 doesn't go very far.
Yeah, so delaying your benefits to maximize as much income as you can get
right.
would be that much more helpful to somebody who didn't have a whole lot saved.
Exactly, and fortunate for our clients, most of our clients do have a sizable nest egg saved. And so, in our opinion, it typically makes sense for them to actually collect early. With the whole concept is that we are investing that nest egg and earning them interest on it. And then that nest egg is also transferable to their children if something happens to them where Social Security might not be the case. And so it's different. The point of that, I think your question here is that it's different for everybody. There is no one-size-fits-all answer.
Right.
That's why financial planning is very critical to your retirement plan. And it's just we want to make sure we can run actually different scenarios. We can show somebody, hey, if you take it at 62, this is what it looks like. If you take it at 67, or if you take it at 70, we can go over all those scenarios and kind of weigh the pros and cons of each.
And the big question that obviously we can't answer is it all depends on, when you're going to pass, unfortunately.
Yeah, how long your plan lasts is really what's going to drive that. And so that's what we're looking at. So that's a good point. We're happy to run those scenarios for our clients.
Sure.
And, it's good news, though. So it's good changes coming with Social Security for 2019. People that are currently receiving it are getting a little bit of a raise. So, again, the whole topic of our show today is all about your income. So you are getting a little bit of a boost there, which helps.
And if you're collecting early, you can earn a little bit more, too, if you're working.
Yep, good point.
Yep.
Okay, so on to our new segment that we wanted to introduce today is that we wanted to... Corey and I like to have fun with each other, and we like to see if we can stump each other a little bit. And so what we're doing is...
I think you like to see if you can stump me more than anything. But,
maybe it's more fun for me. But what we're trying to do is we wanted to ask each other tough questions that clients or potential clients have been asking us lately. And because we think that many of our viewers are maybe asking the same questions. And so we wanted to help educate our audience into, basically some very common questions that are out there right now. And certainly with the current market environment being all over the place, volatility is definitely here. I wanted to address some of those questions with you today. So do you want to ask me first, or do you want me to ask you first?
Go ahead, fire away.
All right, so I had a really good question here lately from one of our clients. And they basically asked, I typed it up here, with the recent market volatility and the fears of a looming recession, is it time for me to get more conservative in my portfolio?
Good question. Yeah. So naturally, I think that people are a little bit more fearful, of course, when the market downturns the way that it has, and especially when it's kind of accelerated over the last few weeks. But I think the conversation that I would have, if you were a client asking me that, is what has changed in terms of some of your long-term goals. Now,
well, let me
go ahead.
Play rebuttal then. So if you asked that, I would probably say, well, nothing's changed. The idea, though, Jake, is that I'm, in my 50s or 60s, and I can't afford to go through another 2008. I don't want to see my portfolio go down.
Right.
So nothing's changed with my goals. I just don't want to lose.
Okay, fair enough. So with that being said, then I would, if you were posing that to me, if you're suggesting that you would want to get more conservative, what does that mean to you?
Taking money out of the stock market.
How much?
All of it.
Taking it all out of the market.
Or actually, if I'm 60% stocks, maybe I want to go down to 40%.
Well,
so do you think I should do that?
Well, I think what we should probably do is if that's what you would like to see, or that's what you think might make sense for you to do, is I would think it would make sense for us to run your financial plan based upon that. So if we did change your target allocation from stocks to bonds, and if we did change, that would ultimately change what your target return would be. And then I think we would evaluate whether or not your long-term goals are still feasible.
Good answer, Corey. That's exactly what I did with the client. Is that, and we're still in talks with running different scenarios, and we want to see what that lowered stock allocation would do to their long-term performance, and then see, most importantly, how that impacts their financial plan. Because again, we're not the advisors that are just going to sit there and say, oh, just write it out, everything's going to be fine. I mean, ultimately, your capital is doing you no good if it's causing you concern,
right,
or scaring you. So if you want to get more conservative, which, again, we would recommend now is not the time to do it. But even if you do want to get more conservative, let's see what that does to your plan. And if your plan still looks good by being more conservative, then let's do it.
What if it doesn't look good, though?
Then that's when our job is as professionals to say, hey, this isn't good for your long-term plan, just like anything else. Just like I wouldn't put all of their money in Facebook stock because it's not in their best interest. I'd say it's not in your best interest to get more conservative.
So maybe this, I don't know if this qualifies as my question, but here's what I'm going to ask then. If you said your plan didn't work, if we lowered your target return, but you're telling me my money's not doing me any good if I'm losing sleep over it, if you're telling me that I can't afford to get more conservative, how am I supposed to just stop worrying about this?
Right. So then I start pulling out the facts and say, okay, well, let's look at how much you're actually down this year. And maybe they're only down 4 or 5% because their bonds are helping them. So we go back into asset allocation. I talked a lot about their bonds and the role that they play in the portfolio to protect this. I talk about the individual stocks that they do own. Great solid companies that have been around for a long time. So it's not just a matter of seeing the whole market go down. It's like, well, what do I basically we lifted up the hood and we said, what do you actually own and why do you own it? And actually we brought in our investment analyst, Jesse, into the meeting to comment on a little bit more detail of why we own each individual security and measures we're taking to protect them.
Yeah, that makes good sense.
And that's all you can do. I told him to turn off the television.
Yeah.
Good
advice.
Because that's a big part of it right now is the media, they have to sell newspapers and they have to sell airtime. And I'm not saying that what they're doing is necessarily bad, but you have to take it for what it is.
Yeah.
If they told you everything is going to be fine a year from now or 5 years from now, you would turn off the television and they wouldn't be able to sell the ads that they're selling right now. So you have to be careful with that. So all I did is I pulled out the facts and then I talked about each holding as much as they wanted to hear about it, so that they knew exactly what we were doing. And I think they walked out of here feeling a lot better about their situation. They know that we're paying very close attention to it. They know that this is something that we've been through before, and it'll probably happen again. And so it just, the market rewards the disciplined investor. And they kind of looked at me surprised when I said, if anything, you should get more aggressive right now, because that's the reality. Warren Buffett, is probably one of the best investors of all time, and he always talks about buying when other people are scared.
Right.
And selling when other people are greedy. And this is an exact example of that. Last year, we were selling because the market was doing well. And this year we're buying because now it's on sale. It's cheap.
Right.
So anyway, you did a good job.
Well, thank you.
You answered it the way I did at least.
I think that's interesting though, because I do think, to your point, that the market, and because people are emotional and humans are involved, it tends to kind of overshoot on the upside, but it also tends to overshoot on the downside. And I think that, just like to your point, for whatever reason, I think it's probably because the studies have shown that the feeling of losing money is more painful than the feeling of gratitude or goodness when the market's going up.
Absolutely.
That when the market's going up, people assume it's going to go straight up forever, and when it's going down, people think that's just going to go to zero.
Yeah, they think exactly. And the market's never gone to zero.
Right.
Right, since they started it. It's never gone to zero.
So would you say this time is not actually different?
Right, exactly. I mean, it's the same as it's always been.
Yeah.
What question do you have for me?
Yeah, so the question I had for you also pertains to current market conditions, but I had a newer client that I was meeting with, and we had talked about their financial plan. This is probably only the second time we've reviewed, and since they've come on board as a client, and in that time frame, unfortunately, the market hasn't done great, and we understand that. But the question was, my financial plan and some of the scenarios that I've ran assumes that I'm retiring in 2019. Given what's happened in the market, how could I possibly even think about retiring now?
Great point. And so how do you have them allocated? What's the blend?
And here's another interesting point. So this particular client is invested with 70% of their portfolio in stocks and 30% of their portfolio in bonds. Now, it's not necessarily that it's husband and wife, both are working, both are saving, both have money saved for retirement. It's not that they want to retire necessarily at the exact same time. It's not even that this person wants to retire next year, but they want to know that if they decided to, they could do so comfortably.
Right. So I would answer that question. We have the portfolio moderately aggressive because they're still working and saving. Depending on the size of the portfolio, which we don't need to go into, I'm sure that we have an adequate amount to weather any type of temporary pullback like this. So I would simply answer the clients clients retire in all types of market conditions, and you can't time it perfectly.
Right.
The idea, though, is you're absolutely right, Mr. and Mrs. Client, that you don't want to sell your stocks when they're down to fund your retirement income. So what I would talk about is looking at the fixed income portion and the bonds and how we would handpick bonds to sell or live off the interest for their retirement. And that I would guide them down that path, because we've had clients retire right before market corrections,
right,
and they're still fine and they're still retired. And there's, I was looking at, I think Ben Carlson with Ritholtz Wealth Management.
I read that post last night.
He posted something really
commented on it.
Yeah, he posted something really good on Twitter. He did a study where he did a what if basically of clients retiring during the Great Depression, I think during the 70s, and then right before the dot-com bubble bursting, and he did it based on I think a 60-40 blend of stocks to bonds. But basically his research, and it wasn't perfect, but his research was basically saying in all three of those instances, those people were still fine pulling money from their account as a retiree, just letting the markets do their thing and do what they do. If somebody retired in 2008, certainly their stocks were down when they retired, but the market's up almost 300% or somewhere around there in the last decade.
So as long as they didn't have to touch those stocks when they were down.
That's key. So the two things that we do for our clients to help protect that is, one, we have the bonds. And then two, because we're handpicking stocks for them, just because the market's down on a broad metric doesn't mean that all of their stocks are down. So, for instance, we own a company that's tied in with the price of gold. And so gold did well yesterday. So if a client needed money, I could have sold some of that gold stock to help fund whatever they needed. So again, the idea that we're doing the investing on such a custom basis, and they're not just in some product, and writing that down allows us to be more strategic when we're looking at their retirement income.
Sure. So let me ask you this question. One more. This is a little bit more kind of a personal question, but it pertains to the same thing. We know that everybody's emotional about their own money, and I know that clients feel like, especially if they're retired or getting very close to retirement, that they don't have a lot of time to allow to make things up if they lose money. For you personally, what kind of impact does seeing the market pull back? I just read this morning that the S&P 500 is down 17% in the last 90 days. Mm-hmm. What kind of impact does that have on you personally?
On me? Mm-hmm. Me personally?
Personally, psychologically.
I think it's an enormous buying opportunity. Just based on my personal goals, I'm investing for the long term, especially with my stocks, obviously, which all clients should be looking more long term with their stocks.
Sure.
I think it's a great buying opportunity. But personally, as a professional, it does bother me in the fact that I know that my clients get a little nervous.
Yeah.
And I just want to help them. I don't want people losing sleep. I don't want people scared. I don't want people making irrational decisions.
Right.
So as a professional, it does cause me a little concern just because I'm here to help people. Personally, as an investor, I see it as a tremendous buying opportunity because, we've got to believe that the markets are going to be higher 10, 20, 30 years from now. So why not buy when something's on sale? It's cheap. It's cheaper than it was 90 days ago.
Right. And then to your point, if I am a client and I retired this year or I'm retiring next year, should I also view this as a buying opportunity?
Absolutely. I'm not saying that you should go all in and blow your financial plan out of the water, but I definitely think if you do have some extra cash or it's time to rebalance, those are things that you should be looking at. So if you're underweight stocks, you should be buying them now.
That's a good time to buy.
Yeah, and again, none of this video or our show constitutes investment advice because it's on a case-by-case basis. But it definitely, you should be looking at it more as a buying opportunity, not a time to get more conservative. This is the wrong time to get more conservative.
That's good advice. Good. I was just curious because I've had people ask me that before.
Yeah. So no, it's really good. If you've got to look at it a little bit differently and pull the facts out of it.
Sure.
Okay, good. So again, to go along with our theme of our show, our third investing topic today, we wanted to talk about generating more income from your portfolio, and one strategy that we use for some of our clients to help them accomplish that.
What's that strategy?
Okay, so something that we use that not a lot of other advisors do are something called selling covered calls, and that's a technical term. And basically, it's a contract where you're giving the right for somebody else to buy your shares of stock over a certain time frame for a certain price. And I'll throw out an example here for you.
Okay.
So let's say that we're dealing with XYZ company and you bought it for $40 a share.
Okay.
Okay. You could sell somebody the right to buy your shares from you. And let's just say $45 a share between now and the month of April. All right, this is just a very generic example.
Okay.
For doing so, let's say that you collect $1 for every share that they're willing to buy. And
okay.
Go ahead.
Time out. So somebody's paying me for the right to buy my shares down the road at a higher price than where it trades today.
Correct.
Got it.
And the reason they would do that is their whole argument, or the other side of the trade, would be that they think XYZ stock is going to go, let's say, to $50 a share. So they're willing to pay you for the option to buy your shares at 45 because they think they're going to be higher than 45.
Got it.
And let's say in this example that you collect $1 a share for doing that. So let's say you have 100 shares. By the way, that's how the contracts trade is in blocks of 100. So you would sell away the right for someone to buy 100 shares. You get $1 a share. You collect $100 today for doing that trade. Okay, not a lot of money, but it's $100. Okay, and so then we wait. And we wait until now in April. And it'll be a specific day in April, but there'll be a time when that contract ultimately will expire. And if your XYZ stock stays below 45, typically what will happen is nothing. You pocket the $100, and we go and do this again.
And that person sort of lost.
They lost their $100, their contract money for $100. Now, if XYZ stock goes above, the $45, even by a penny, they have the right. They have the right anyways to do it, but they could do it even if it was for a penny. You wouldn't get to sell your stock at that higher price. You would be forced to sell it at 45. So there is risk associated with doing this, and the risk is on the upside. It's not necessarily as much as on the downside, but there's more risk on the upside that you're foregoing potential earnings or growth from that stock.
Okay, so what type of, generally speaking, what type of market environment does this strategy work very well in?
Yeah, so it typically works best if you think that your stock price is going to remain flat or go down. And that's the environment we're in. I mean, obviously the market, we're hoping that it bounces back quickly and goes back, but nobody knows. But over the last few months, because the market has been trading sideways or down, these options have been paying off for our clients. And they're generating income. They're not having to sell their stocks. And so the idea is that as their account's going down, it's going down less than another investor who's just owning stocks or just owns mutual funds or index funds. It's not doing this. So this type of strategy is for someone that is retired and that wants more income from their account. And that's our whole mission here, is to generate more income off of their holdings rather than just riding the wave up and down. I want to take advantage of this volatility, and I want to generate a return that they can actually pull out of their account and live off of.
And I know obviously, the market is efficient, but isn't it? My understanding is that in periods of heightened volatility, whether the market's way up or way down, that selling these options and the premiums that you generate are greater when there's more volatility.
Right, exactly. And so it's just like the stock market. There's an options market. I believe they trade in Chicago. And you're right. So those prices change based on volatility. So even the client could even potentially collect more by all of this happening. And so that's something that our analyst helps with the research on. You and I and James are making the decisions based on what we're doing. James is our third advisor. And so again, it's just another opportunity to generate income for our clients.
So that's one more question I wanted to ask then. If we are buying 35 individual stocks for our clients, would you go and sell these options for every stock?
We were originally taught to do that way several years back, but we don't believe in that anymore. So what we're doing is we're measuring the potential volatility risk from that stock jumping way up or down, and we're being selective. So we're not doing it on all 35 necessarily, but we are doing it where it makes sense based on potential volatility, future volatility, I guess, is what we're looking at.
And I guess is the goal then in a perfect world, for the stock to not get called away?
Yeah, ideally. Of course we want the stocks to go up over time.
Sure.
But, really it doesn't matter if it gets called away, to answer your question. The idea is if it did get called away, we would have made a profit anyways, because it's not necessarily a bad thing.
So we made the money up to the price that it get called away at, plus the premium that you collected when you sold the option.
It's a great strategy for somebody that wants income off their portfolio. It's a great strategy to do that for, and that's why we do it. And if your advisor's not doing this, it's either because they maybe don't understand the options market, or if you're invested in a product, you typically can't. So if you're
what I was going to ask.
Yeah, if you're in an annuity or a mutual fund, you can't trade options on those types of vehicles. And so the advisor now just has your money in something they're just riding a wave up and down, where we would much rather generate a return for you while we're waiting for this market to recover.
That's good. That makes good sense.
Yeah, and it's working quite well. And so that's a huge value add to our clients that not a lot of advisors in Kansas City do, as far as what I've come across.
Yeah, same here. I've run into the same thing, where it's not a common thing. And I found that people that are invested for retirement or have advisors currently, their interest is usually piqued by the strategy because no one's talked to them about it before.
Yeah, exactly. So good. Just another way that we look to add value to our clients and differentiate ourselves from other advisors who are out there who are just pitching products, frankly. And I don't see much value that they're adding when they just put you in a mutual fund and tell you to sit on it and do nothing. I don't know why you would need an advisor for that.
Well, maybe they have sales goals to hit.
I guess so, maybe. We don't have to worry about that.
That's right.
Okay, on to our global topic for today. And in this segment, I always like to stump you, Corey, or catch you off guard. So with 2018, wrapping up here quite soon, I wanted to see, reflecting back, was there a favorite book or movie or show that you watched this year that maybe you can share with our viewers to maybe as a recommendation?
I can. And we maybe have talked about this on a podcast before, but I think that the first thing that jumps into my mind was the book Shoe Dog that Phil Knight wrote.
I think you brought that one up before. I read that one too after you recommended it. It's a really good book.
I think I read, I don't know, maybe not as many as I would have liked, but probably 6 or 7 books this year. I think
Good
so.
Good for you.
Yeah.
I think I'm at 8 maybe.
Yeah, and I think that one was far and away.
That was your favorite one?
Yeah, definitely.
What was the takeaway for you on that book?
I think perseverance, overcoming adversity, And I think that just sort of hearing the story about from when something was started and the vision that somebody had for what it could become, and then kind of, really putting themselves out there over and over and over again to kind of try to realize that dream. And then also having the self-awareness to recognize mistakes that they made along the way. I think that's important too, because I think people become, they get kind of a larger than life persona or an ego, and they think they can do no wrong. And, I think for somebody who's been that successful to have the awareness to recognize, what, I did some things right and I did some things wrong. And if I could have done things differently, I would have. Fortunately, this is where I've ended up, and this is what it took to get there.
Yeah.
And assembling the team around him and bringing in the right people that had the right skill sets, and shuffling things up when they needed to be shuffled up, and dealing with kind of some major adversity when they had to deal with some adversity. It was one of those books that from basically the first page that I started it, I just kind of tore through it. It didn't take me long at all to finish it.
Yeah, I think the note I had from that book, because I read it as well, was to never give up.
Yeah.
He kind of just kept going. Like you said, perseverance. He just kind of kept going. I'm getting ready to write a blog, and maybe you will as well, giving a brief review of all the books I read this year. And I think, by and large, in a way, the most impactful on my life was A New Earth by Eckhart Tolle. One of my mentors gave me this book, and it was definitely a life changer for me. The takeaway on that, it's a really good book, and not everybody understands it, which is fine, but he talks a lot about dismantling your ego and living in the present moment. And, basically we have three choices in life. We could either accept what is, we can enjoy things, or we could live life with enthusiasm. And I try to think about that every night, actually, now before I go to bed. It's just to remind myself that that's a very awesome way to go through life and enjoying yourself. And so, I thank my mentor for giving me that book and helping change my life for the better.
It's pretty deep.
Yeah, I know. And I didn't want to get too deep on this, but I encourage our listeners, if they are looking, for something like that. Like I said, it was a pretty awesome book for me. I believe it, and I believe it has helped me tremendously and continues to help me to this day. And I actually probably will continue to reread that book because it is so powerful to me. What about on the lighter topic, maybe any shows or anything?
As far as shows go,
any movies or anything?
It's the same thing with movies. I'm really not a big TV show or movie guy.
Yeah.
I've watched Game of Thrones. That's one that I've always.
Was that out this year?
No, there was not even any. I don't think it comes out again until.
So this was 2018.
Yeah, I'm trying to think. I'd have to give it a little bit of time to think about it. I watched. I don't know. I have to think about it.
I got two. I watched that Narcos Mexico on Netflix. Thought that was pretty awesome.
Yeah.
That whole Narcos series is pretty fascinating to me. They do a really good job with it. And then I'm excited. Showtime's coming out with Billions here in March, the next season. Have you watched any of the Billions?
No, and I know everyone tells me that if I'm working in the finance industry that I need to watch Billions, but I haven't watched it.
It's a really good one. I'd recommend you catch up on that one. It's a good one.
I thought I just came up with it. Definitely the favorite show that I watched this year was the show Barry on HBO.
Oh yeah, I haven't seen that one. What's that about?
So it's about Bill Hader, the actor Bill Hader, I think he actually wrote.
Was he on Saturday Night Live?
Yeah.
Okay.
Mm-hmm. He's been in a lot of things, and I think he actually wrote the show. But it was about So he was in either Afghanistan or Iraq, and he was a very decorated war hero. And I think he was a decorated war hero. Came back to the United States, had kind of some trouble figuring out what he was going to do after war. And this is a little heavy, but he ends up an old family friend of his father. Recruits him to be a hitman, believe it or not. So he's actually a hitman, and he gets sent to LA for a job that he's supposed to do, and he stumbles into an acting class, and then he decides that he wants to get it.
It goes all over the place.
So he decides that he wants to be an actor, but it's also while trying to follow through on what he was there to do, which was become a hitman. And it's like it definitely had some action and some drama to it, but it was also a comedy. So it's not maybe necessarily as heavy as I'm making it sound. It was a little kind of lighthearted, but there was definitely some heavy moments. But I thought it was really good. I think it won a bunch of awards too.
That makes me think of one more, and then we'll wrap up our show. Is Jack Ryan? That was a good one on Amazon.
I need to watch.
Yeah,
that.
Rachel and I really enjoyed that one. So, anyways, that's all the time that we have for our show today. I want to thank you for tuning in. As always, you can find me on Twitter at Jake Falcon CRPC,
and you can find me on Twitter at Corey Bittner KC.
And our YouTube channel is live, so we ask that you please like our content and subscribe. And as always, if you have any suggestions for future shows, we're happy to discuss whatever topics you would like us to on our show. Thank you all for watching, and we hope you have a great week.